Joining us now is Brennan Hawkin, BMO Capital Markets Senior Equity Analyst. So, Brennan, look, the fear is flying around. Let's start at the epicenter with the alternative asset managers. Some of them have been just weighed down by a constant spiral of concern about what's in these private credit portfolios.
Right.
Is there value there, or should we just sort of assume that other shoes are going to drop?
Well, I mean, they are credit portfolios.
Yeah.
Right. And you make a loan, it's not like there isn't an assumption of some kind of level of loss. So, like, and they charge for it. They charge a premium yield,
yeah.
Right? Typically SOFR plus 400 or something. So there's risk in these portfolios. There will be losses. What I think is the reason why everybody has drawn so much attention to these portfolios is, generally speaking, the rule of thumb for a bank analyst is when you're going in, if you're going to go into a downturn or a credit turn, you think about where has the loan growth been. Odds are that's where the problems are. That's what happened in 2008. That was when I basically was learning how to do this job. And the clear answer was mortgage back then, to some degree card. And typically that's where the competition is. We've seen a lot of growth in these private markets. Yeah. And so that's what everybody's thinking. It's a logical way to approach thinking about a credit turn. And we're starting to see signs that maybe that's beginning to emerge.
There are a couple of issues, I guess, when it comes to these asset managers, and that is defaults on the portfolio, parts of the portfolio itself. But then there's also the other issue of investors being scared away.
Right.
Their limited ability to market these vehicles anymore because people are worried that they're going to be gated and they can't get out, et cetera. So how do you sort of parse through these two things that are weighing simultaneously on this group?
Right. So there's one that is a flow dynamic, right, which would be either gross sales or redemptions, and therefore get you a net number. Those have all been going one way, and now there's an expectation that we could be seeing some redemptions. We saw the beginning of that pick up in the fourth quarter. BCRED had the highest level of redemptions in a while. Gross, and I just mentioned BCRED because it's the biggest, so it's like the poster child, and they're really good and transparent. You can get the data. They've had lower gross sales here year to date. We don't know the redemptions yet. We'll get them in a few weeks. I would say when I talk to most investors, people are expecting they'll go to proration, which is another term for the gates.
Yeah.
And that's typically set to a limit of 5% per quarter. And you do that because they're not fully liquid, right? So you have to have some sort of... Now, the good thing when we think about what happened several years ago with the non-traded REITs versus today the non-traded BDCs, real estate is a much longer dated asset. The duration is really long. Market can be quite illiquid. The good thing about these BDCs is that the maturities are short and they're staggered, right? There's almost inherently better liquidity. Mm-hmm. Now, it doesn't mean that if we're constraining credit flow into that market that we won't possibly make things worse and won't maybe see more defaults.
Sure.
But importantly, defaults themselves don't equal loss, right? These are senior loans. There's often collateral. You're going to recover something. Mm-hmm. So there'll be a lot of concern. There'll be a lot of scary headlines. It doesn't necessarily always translate to the losses, and that's what creates the performance issue. Mm-hmm. And that's the difference in between the flow versus the losses. That's performance.
Do you want to get to Jefferies, the mid-sized investment bank? Stock's been under a lot of pressure. They have this exposure, whatever it might be. It might be it's fraud related. But it always does seem that investors are willing to kind of punish. You know, at Jefferies, it's now trading below book value again. But even the big guys got dragged down with this concern today.
They did. Although I'd say maybe it's below book, but it's not below tangible book.
Yeah, right.
Still at about a 50% premium, maybe 40 after today. And that's the way investors, when we get into a market that's scary, people use tangible. So Jefferies, this isn't the first. So we got this MFS issue that emerged yesterday. I had never even heard of this company. I thought we were talking about Massachusetts Financial, and it was the Boston-based asset manager. So we had to, reach out and talk and get an understanding. Unfortunately, the news flow has just sort of continued to deteriorate. And it seems as though a decent amount of this collateral has been double pledged. It sounds a lot like the First Brands issue. Mm-hmm. Now, the ironic thing is there's been a lot of concern and focus on the direct lending part of the private credit market. So far, actually, we've seen issues emerge from the asset-based finance part of and that isn't always private credit. they do have a private credit version. So maybe the focus might shift to be a little more there. We saw Apollo underperform today. They're much bigger in that market. I suspect that's investors saying maybe we need to catch up and think about this more broadly.